Greetings and welcome to the lesson. Today we are going to study the cost of credit under the topic personal financial management. And the lesson objectives are: 1, by the end of this lesson, you should be able to outline the components of cost of credit. Number 2, should be able to explain the impact of cost of credit on personal financial management. 2 lesson objectives on the subtopic cost of credit. And candidates, understanding cost of credit is crucial for informed financial decisions and responsible borrowing. And in personal financial management, the cost of credit goes beyond just the interest rate for a loan. It encompasses all the fees, all the charges that are associated with credit, which ultimately impact the repayment amount. So that's very important. So therefore, we will discuss first of all the key components of cost of credit. Components of cost of credit. Key components of cost of credit. Key components of cost of credit. The first component is interest rate. Number 1, interest rate. When borrowing, the lender expects, or it is expected, that the borrower will pay the lender an interest at a given interest rate. And this interest rate is the percentage of the borrowed amount that you pay the lender for using their money. This rate can be fixed or it can be variable, which may significantly impact your overall repayment amount. Interest rate. Then there is the annual percentage rate. Annual percentage rate is yet another component of cost of credit. This is a more comprehensive measure of the cost of credit because it includes not only the interest rate, but also most associated fees and charges. And this one allows for a more accurate comparison of different credit options. Annual percentage rate. It encompasses all the other charges, the other fees. 3, origination fees. This is another component of credit. Origination fees. This is a one-time charge that is levied by the lender for processing the loan application. And these origination fees can be a percentage of the amount, or it can also be a flat rate depending on the banking or the financial institution. Origination fees, the amount you pay for processing of the loan application. When you make a loan application, that application has to be processed. The bank or the lender has to subject that application to various processes, and that comes at a cost we are calling origination fees. 4, late payment fees. Late payment fees. These are fees or charges which are levied if one, we can say, where one fails to make the repayment. They are charged if you fail to make your monthly payments or your annual payments, depending on the terms of the loan. If you fail to pay on time, then there may be late payment fees. And this can be a significant financial pain or burden, and it can negatively impact the credit score of the lender. 5, prepayment penalties. Prepayment penalties. Some lenders charge a fee if you pay off your loan early. If you pay off your loan early, some lenders may charge you for that. And that can discourage early repayment and discourage you from potentially saving money on interest. Prepayment penalties. If you agree that the term period, loan term period will be, say, 5 years, and you reduce the amount so that you wish maybe to pay in 4 years, that means you've reduced the amount that you ought to pay in the ultimately. So the lender may charge you for prepayment. Some lenders charge a fee if you pay off the loan early. If it's to be paid in 5 years and you want to pay it in 4 years, if you choose to do that, some lenders can charge you what you are calling prepayment penalty. Annual fees. Annual fees. Annual fees. Certain loans charge an annual fees. Annual fee. This is fee that is paid annually for continued access to the credit. Annual fees. We've seen annual fees being paid on credit cards. If you have a credit card, then there could be an annual fee that you pay for continually accessing your loan through that card. Transaction fee. Transaction fees. These are fees that are associated with specific transactions, such as using your credit card or withdrawals from an ATM and so on. So these are some of the components of cost of credit. Let us now study the impact of cost of credit on PFM. Impact of cost of credit on PFM, personal financial management. Now, the cost of credit can significantly impact one's budget and financial goals. Things like high interest rates, hidden fees can lead to overspending, can lead to debt accumulation, can lead to financial stress, and so on. And the question now is, how do you manage the cost of credit effectively? Do you understand, candidates? the cost of credit can significantly impact one's budget and financial goals. One impact is overspending, debt accumulation, financial stress, and so on. So how does one manage the cost of credit? How to manage cost of credit? This is what is most important when studying the impact of the cost of credit. It's obvious this cost can cause financial stress. This cost, if not well managed, can lead to debt accumulation and also overspending. So one way to manage cost of credit is to compare offers. First of all, before you take any loan, compare offers. Shop around and compare what different financial institutions are offering. Compare interest rates, compare the annual percentage rate, and compare the fees of different lenders before settling on a credit option. Another way to manage is to negotiate. Negotiate with the lenders for lower interest rates and fees. Then it's important to understand the terms and conditions. Read the fine print. Read the fine print. What does that mean? Study the terms and conditions of loans. Thoroughly understand all the terms and conditions associated with credit so that you can avoid hidden costs. Make timely payments. Make timely repayments. Because if you don't pay on time, there is what we refer to here as late penalty fees, which can negatively impact the borrower. Make timely payments. Avoid late payments by making monthly payments on time. Pay off high interest debt or credit. Pay off high interest debt. Pay off high interest credit. Prioritize paying off high interest debt to minimize interest charges. 6. Use credit responsibly. Use credit responsibly. Avoid impulse purchases and overspending to manage credit utilization ratio, and also avoid failing or falling into debt. Avoid falling into debt. The money that you are advanced, use it responsibly. Use that money on things that matter. Use that money on things that may also generate more revenue to help you repay the loan. Avoid impulse purchases. Avoid overspending in order to manage credit utilization ratio. Manage credit utilization ratio and avoid falling into debt. 7 is also important to monitor your credit report. Monitor your credit report. Regularly review your credit report for any errors and take necessary steps to correct them. You understand? It's possible for the financial institutions to also make errors. That's how to manage cost of credit. In case of any errors, make sure that the errors are corrected. And you can only tell if there are errors if you regularly review a credit report. Then take corrective measures, take necessary steps to correct the errors. You understand, candidates? So it's important for you to understand that by being aware of the cost of credit and implementing effective management practices like the ones we've listed here, one can make informed borrowing decisions and also avoid unnecessary financial burdens and achieve their financial goals. So that marks the end of the lesson. We've studied the various components of cost of credit and some of the ways in which to manage cost of credit so as to deal with the impact of cost of credit, which we said that can significantly impact one's budget and financial goals. We said that high interest rates and hidden fees can lead to overspending and debt accumulation and also financial stress. Here is today's assignment number 1. What factors contribute to the overall cost of credit for individuals, and how can an understanding of these factors help individuals make informed decisions about borrowing? Number 2, how does one's credit score impact the cost of credit, and what steps can individuals take to improve their creditworthiness and secure more favorable borrowing terms? 3, in what situations is it advisable for individuals to use credit as a financial tool, and how can responsible credit management contribute to overall financial health? That's the assignment. In our next lesson, we are going to study financial alterations. Thank you for attending the lesson. Bye.